So Constellation Software has released their year-end earnings within the past week, and I wanted to give my impression of that earnings release and how the last year has gone. And also at the end of this video, I want to take a look at the interview that the Chief Financial Officer did about a year ago and kind of address how this company is going to look going forward and how they view it and how I'm going to view my investment going forward. So before I just pop into those earnings, why have I been interested in Constellation Software? It's been occasionally a top pick on BNN Bloomberg, and the company's really fascinated me with how few shares they've offered, or the fact they've not increased their share count at all, and their compound growth rate is pretty amazing. So I finally, after following it for a few years, really dived into the financials. And that's the heart of what I want to present here is the update to the financial analysis that I've been doing. So the market clearly liked the Q4 and year-end earnings, and Constellation Software has jumped to a 52-week high. This is one of my stocks that I don't follow super closely. I don't watch it day to day. It's something I really sort of do year-over-year analysis, and compared to all the other tech stuff in my portfolio, it's just amazing how sort of up and to the right it's been, where you pull any chart from the NASDAQ and it's probably down to the right. Okay, so what does Constellation Software do? They buy and manage vertical market software that has recurring fees and licenses. They take the cash flow from those businesses and they reinvest them into new businesses. So they don't dilute their shareholders to grow. They use the cash flow. They are just great allocators of capital, and they do not use much debt. They rarely use debt, though it is something they would consider. What they do view as their best measure of financial success, and it's one of the first things we want to look at in their financial reporting, is free cash flow available to shareholders. That's at least what the CEO prioritizes. Okay, and they could use that free cash flow available to shareholders to pay dividends or repurchase shares, but that's not their number one objective. They want to invest all of this free cash flow as long as it can meet their hurdle rate, and they normally can do this no problem. Back in 2019, I think it was, they had too much cash and they couldn't deploy it all and meet their sort of minimum bar, and they did do a $20 special dividend. Their historic free cash flow available to shareholders has just compounded at really almost an amazing rate. This is from their president's letter, which unfortunately they stopped. They really were a nice read. So this is their data they published up to 2017. And then I took their financials and sort of continued to build this table on my own because I like it. And this is what their CEO says is their number one metric. So I sort of rebuilt it, making sure my numbers match theirs in the first few years, and then this is my version up to 2022. So we do have a bit of a hiccup. Their 2022 full year free cash flow available to shareholders was only constant compared to the year before. Now their revenue continued on their sort of nice, significant compounded increases of, let's say 30%-ish, and the revenue per share did that fine. Their net income I don't pay too much attention to. It bounces around a lot. It's the free cash flow that I really look at. So we need to dive, why do we have this sort of flat free cash flow year over year where the revenue is sort of continuing to do what Constellation Software has done the last almost 2 decades, which again is what I find so amazing, how long they've compounded. I've never seen a company to do what they do in terms of shares. They've issued no shares. And again, this is what, when I originally started investing, viewed as what I thought all companies should be doing, is not issuing more shares. So why do we have that hiccup? The first always potential reason to have some hiccups quarter over quarter, at least according to Constellation Software, is that the first quarter is typically the highest, and they typically see a second quarter as a dip or the lowest quarter. But in 2022, there's a particular anomaly that we're about to see shortly. So this is their chart in their financial statements over the past 2-ish years. Q2 of 2022 is why we don't see that sort of nice compounding in the free cash flow available to shareholders and just in the revenue. So we have this barely 50 cents of free cash flow available to shareholders and a dip in the cash flow from operations. These two kind of end up going hand in hand. So let's take a look at what they say is the reason, and let's see how the market judged their reasons and their subsequent quarters by looking at what their share price has done. So we see in Q3 and then the most recent Q4 kind of a return to typical free cash flows available to shareholders. So jumping back to their Q2 financial statements, so again, the black box. Okay. So they talk about the same negative impacts that affected free cash flow as cash flow from operations, as the reasons for the free cash flow drops. So I had to jump up one paragraph. And this is what they say about free cash flow from operations and the decrease, and kind of focusing in ultimately on the orange. So the primary reason for the decline in cash flow from operations over both the 3 and the 6 months, so Q1 and Q2 of 2022, was the impact of non-cash operating assets and liabilities from the effects of business combinations. And they're constantly buying new, some relatively smaller companies and adding them into the Constellation Software family of companies. So specifically in the 3 and 6 months ending in June of the 2022 year, the most recent year, there was $188 million and $18 million of cash used in non-cash working capital. So emphasis sort of on cash being used. Compared to the previous year, it was only $99 million used, so 1/3 or $100 million difference, and $100 million generated in the 6 months. So there's a big difference here in sort of non-cash working capital coming from business combinations. So that's what they're saying is the reason for this sort of year-over-year blip, which affected quarter-over-quarter difference, which affects the year. So we've got this one quarter that's off. Now, I'm not going to make any statements of whether these are good reasons or not. I'll leave that up to you. They're saying that they don't have any concerns with account receivables or unbilled revenue because of this. Okay, so that's the reasons, sort of business combinations and a big difference from one year to the other. So how did the market view this? In Q2, the earnings came out around where the first red X is, and the stock didn't initially tank. It was somewhere within the next 2 weeks, it reached sort of a 3-6 month peak, and then the stock really declined. Okay, had a little blip up, and what caused the ultimate bottom or near bottom was their Q3 earnings. Ever since their Q3 earnings came out, the stock really rebounded. So clearly the market was very skeptical of their reasons in Q2, but in Q3, we kind of got some solid numbers again. So this is what started to drive the stock back up. And then we just got the Q4 earnings even higher than Q3. And we can see sort of the result was a 52-week high based on the Q4. Okay, so the Q3, so if I put in the other quarters, Q2 is about there, Q3 around here, and then Q4, so that dip, and then we've been off. Okay, so have a little bit of skepticism due to that quarter. I'm not going to totally ignore it, but we've got 2 quarters of sort of mean reversion. So I'll really be watching next year to see whether we have another hiccup or whether we just continue to see the nice consistent growth. Okay, and this led me to reading the sort of chief financial officer's interview, or rereading that, and looking at how does the company look going forward after all the growth over the past near 2 decades. So this interview is, again, pretty much exactly a year old, but I think the information is still very relevant on how I or you may want to perceive this company going forward. So he starts the interview off sort of repeating what the company does. Okay, there are so many pieces to Constellation Software that I considered including them in a past video, but it's just way too much to talk about. Okay, so they have a huge amount of businesses. The company started a lot smaller. The corporate structure has evolved and scaled over time. Okay, and again, this is the chief financial officer's words. For the first 10 years, everything was pretty much run from the top and the head office. They would approve everything. But it's a very different Constellation Software that we have today. They've now pushed down the decision making to more local group heads. Okay, so over the next 10 years, so running more into the current time, acquisitions are not made at the top. Okay, and eventually we decide to let operating group heads approve merger and acquisition transactions up to $20 million. Okay, so we went from sort of a central structure down to these, they kind of call them mini Constellation Software companies making the decisions. Okay. So again, the chief financial officer's words today, almost everything that they buy is decided by these 6 group heads or mini CSIs. Okay. And that over time, this structure will continue to evolve with more branches, and there'll be more sort of local or group heads making the decisions on how to deploy capital, at least up to a certain threshold before it moves up to the very top. Okay, so this company is all about taking the cash flow and deploying it. This company has been a great allocator of capital. And our concern is, will they continue, and will the structure continue to be a great allocator of capital? I was really curious. I find their lack of issuing stock very unique. Okay, and they say they don't like to issue stock options. Okay, and instead that we take the cash that we have that we issue as bonuses, and we buy shares in the open market for their employees. So they don't dilute with shares. They just use cash to buy shares. This is what I originally, when I started investing, thought how things should work. You issue shares and you don't issue any more. You certainly wouldn't issue it to more employees. That would be an expense, and you would just have to pay for it. But that's clearly not how the capital markets work. So again, this statements are from a year ago. So their balance sheet is very healthy. Okay, they never issue shares. I kind of thought that maybe they just didn't use any debt, so they're not totally opposed to debt. And I believe in the last year they have used some, and they do have a credit line, but it's not something they use regularly. Again, it's largely that free cash flow available to shareholders that they are using. And that free cash flow has really grown. So over the last 2 years, both in 2021 when this statement was made and the last year, they're generating over $1 billion a year in free cash flow to deploy. So they almost have a good problem of so much cash to deploy. Can they keep deploying it and have a similar return on invested capital and growth rates of the last decade and a half? I would not expect their growth of 30 some percent. I think it's compounded 36 over the last 18 years. I'm just going to quickly flip back to that. Yeah, so almost 36%. But even if it did this 20 to 25, that would certainly be more than positive. Okay. So I haven't picked up any shares lately. My most expensive shares is about 2,100 Constellation Software, with the NASDAQ and tech companies going down. And Constellation going up, it's grown to my third best position. I don't think I'll add any here, but if they did dip, I'll slowly probably add some. And this is something I want to buy a few shares a year. I'm a little out of date for this year, but it's still fairly early. So I'm holding the position. Again, not buying more right now, and definitely wanting to see that free cash flow available to shareholders actually grow this year and not have any hiccups. Again, it's not a smooth growth from quarter to quarter, so it's hard to make judgments after Q1 or the expected dip in Q2. So I'll revisit this at the end of the year. I'll certainly look at those quarters, but probably not make any big decisions. So hopefully this video helped a little bit in understanding the company and maybe understanding how the stock has moved over the last year. It doesn't have a lot of volume. It's not super liquid. They don't do conference calls. You don't get a lot of news on this company. But I think it's a good one, particularly for young investors, to really slow down, take a long-term perspective at. Not something certainly to be day trading and getting in and out of, but it's good to slow down and really take a long-term picture of stocks, again, particularly when you're young. I love this one that I can just sort of slowly build a position, and I don't trade in or out. And you need some nice stable, or lots of nice stable positions that you just do modest amounts of work on each year.